Have you ever seen a rich person really upset about a recession? Probably not, because when things go south, their cash tends to go up. Warren Buffett even says so himself. So, who's coming out on top when the economy's in a slump? It's the rich guys like him, whose wealth has shot up big time over the years. But how is this the case? And should we start investing during a time of recession, just like the big guys? Stick around to find out. With inflation going up and talk of a recession coming, lots of folks are freaking out about what it means for their money, jobs, and future. But maybe we're missing the big picture here. Turns out downturns in the economy can actually be a chance to make a lot of money. Some folks say it's a rare opportunity that only comes around once in a while. Think of the economy like a game where the wealthy have all the tricks. Before we dive into an interesting chart, let's ease any worries about recessions and stock crashes by listening to some wise words from Warren Buffett. He basically says that while the economy has its ups and downs, it's been chugging along pretty well since forever. Sure, we had a really rough patch in 2008 and 2009, but that's just part of the deal. The important thing to remember is that recessions are normal in the economic cycle. And if you play your cards right, they can actually be great opportunities to improve your financial future. The stock market may take a hit, but it will always bounce back even stronger. Buffett assures us that there are plenty of wise investment choices that can still grow our wealth, even in these tough economic times. The Oracle of Omaha even famously said that bad news is music to the ears of an investor. Now, let's delve into what Buffett expects to happen in the next 3 to 6 months and the promising opportunities that come with it. Pay attention, because what you're about to hear will help you strategize for long-term money-making. To start, let's uncover the mysteries surrounding the economic landscape you'll likely be facing in 2024. It's important to recognize that during economic downturns, unemployment tends to rise. But even if there aren't major layoffs, other drawbacks like substantial wage cuts and declines in the value of various assets such as stocks, energy, food, and services become widespread. These effects can reverberate globally and have damaging consequences. Additionally, in a recession, corporate profits typically decrease, with companies reporting lower revenues and offering cautious outlooks that reflect the heightened risks associated with economic downturns. Unfortunately, there's a significant possibility that the United States and even the world could face another economic recession next year. Furthermore, while extreme weather events have been sporadic and localized so far, there's a chance they could become more frequent and widespread. Intense droughts and heat waves in particular have the potential to disrupt production, leading to food shortages, straining global supply chains, and increasing household expenses. In areas where food scarcity is severe, there's a risk of mass migration or even conflict, with far-reaching political consequences that could extend beyond borders. What about the tension between China and Taiwan? This could significantly impact the semiconductor industry, causing widespread repercussions. Additionally, the ongoing conflict between Israel and Hamas shows no signs of easing, though the likelihood of it escalating into a regional conflict is low. However, the global repercussions of such an event would be substantial. Recently, many companies have been revising their forecasts downwards, anticipating slow or negative growth. This signals the highest level of recessionary risk seen in a decade. Consequently, layoffs are expected to become more common as companies strive to streamline their expenses due to reduced spending by cash-strapped customers. Unfortunately, it's usually the employees who bear the brunt of these cost-cutting measures as firms seek to save money by reducing their wage bills. Indeed, companies are already implementing mass layoffs. According to Bank of America, the United States is projected to lose approximately 175,000 jobs per month. To illustrate, let's consider just 4 companies out of many planning to downsize. Nokia, the Finnish telecom company, plans to let go of up to 14,000 employees as part of its cost-cutting measures, affecting a global workforce of 86,000. Paramount Global is set to close its Showtime sports division by the end of the year, resulting in unspecified layoffs. Rolls-Royce plans to trim 2,500 jobs worldwide to address years of underperformance, affecting about 6% of its total workforce. Additionally, Stack Overflow has laid off 28% of its staff just a year after doubling its workforce. So, you're probably wondering how all this bad news could translate into golden opportunities for investors and the average person to capitalize on, aren't you? Don't worry. We'll talk about that right now. Now that we've covered the potential challenges, let's explore why this upcoming recession could actually be an opportunity to build wealth and secure generational prosperity. Firstly, as mentioned earlier, during tough economic times, larger companies often opt to cut expenses or even shut down. However, what may be detrimental to some could be advantageous to others. This creates openings for smaller, more nimble businesses to emerge and establish themselves. Secondly, everything tends to become more affordable during economic downturns. While downturns are typically viewed negatively, it's crucial to shift this perspective. Thirdly, it's essential to remember that after every bear market, a bull market follows. Historical data supports this pattern. During recessions, the S&P 500 tends to decline by an average of around 30%, but after hitting rock bottom, the subsequent years often see significant rebounds, with average returns ranging from 42% in the first year to 60% within 2 years. Investing during a market decline can potentially yield substantial returns compared to withdrawing and waiting. Fourthly, economic downturns lead to a natural selection process in the market. While the peak of a market cycle may favor large established companies, downturns often weed out those that cannot sustain themselves, creating opportunities for newer, smaller businesses to thrive. Furthermore, it's crucial to consider the long-term perspective, as the market has consistently rebounded in all historical instances. Remember this valuable advice from Warren Buffett on long-term investing. You shouldn't buy stocks unless you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them. Well, that's about it for today's video. Let us know your thoughts and opinions in the comments below. Do consider liking this video and subscribing to the channel while you're at it. Thank you so much for watching, and we'll see you on the next one.